Welcome to Performance Optimization Strategy Basic. Myself, Surjit Kakkar. For information on our products and courses, you can visit www.surjitkakkar.com. Before moving ahead, please make sure you go through the disclosure. I will keep it on the screen for some time. Performance Optimization Strategy Basic Part 1. In this lesson, we will cover terminologies related to demand and supply. We will understand why price moves. We will get introduced to demand supply methodology. We will also talk about the mistake which novice traders make and what should be our actions. Trading analysis can be divided into two parts: fundamental analysis and technical analysis. Fundamental analysis is the analysis of a business financial health, usually to analyze the business assets, liabilities, and earnings. When applied to futures and forex, it focuses on the overall state of the economy and considers factors including interest rate, production, earnings, employment, GDP, housing, manufacturing, management, etc. Technical analysis is a security analysis methodology for forecasting the direction of price through the study of past market data, primarily price and volume. If you look at them broadly, this is what fundamental analysis teaches. If a company is fundamentally strong, we should buy, and if a company is fundamentally weak, we should sell. Talking about technical analysis, every trading book teaches that trend is your friend. Therefore, in uptrend, you should buy, and in a downtrend, you should sell. Let's look at it as an example. A stock is currently trading at 100 rupees. From 100, it starts moving up to 110, 120, 130. Since the price has been moving up, technically we will be in an uptrend. And like every trading book teaches us, in an uptrend we should be buying. And since the value of the company is increasing, most probably it will be a strong company. Therefore, even fundamentally we should be buying this stock. Now let's take the opposite case. Let's assume that instead of moving up, the stock was moving down to 90, 80, 70. Since the price has been moving down, technically we will be in a downtrend. And in a downtrend, we should be selling. And since the value of the company is decreasing, most probably fundamentally it will be a weak company. Therefore, even fundamentally we should be selling this stock. So this is what most of the traders do. Since we are in an uptrend, therefore they buy. Fundamentally strong company, therefore they buy. And not just this, even because of the emotion of greed, they buy. On the other hand, if the prices are moving down, since we are in a downtrend, therefore they sell. Fundamentally weak company, therefore they sell. And even because of the emotion of fear, they sell. Now let's take an example of a cell phone which is currently for 70,000. Let's assume that you meet a person who is in need of urgent cash and is willing to sell it for 65,000. What would you do? If you find it even cheaper, let's say 60,000, what will you do now? Let's assume 55,000, 50,000. You are getting cheaper price. What would you do? I am sure your answer will be you would love to buy at this cheap price and maybe even more than one phone, because logically the correct action is to buy cheap. But for a minute, if we look at it technically and fundamentally, technical analysis teaches us that in a downtrend we should sell, and if a company is fundamentally weak we should sell. Now what if the prices were moving up from 70,000 to 75,000, 80,000, 85,000, 90,000? Since the price is getting expensive, what would you like to do? I am sure you would not be interested in buying it. Instead, you would be happy selling it at expensive price, which is again the logical thing to do. But if we look at it technically and fundamentally, Technical analysis teaches us that in an uptrend, we should buy, and if a company is fundamentally strong, we should buy. If you have been trading, I am sure you would have experienced that as soon as you buy, the stock or the script starts moving down and you feel that someone is keeping an eye on your trades. The reason this is happening is because when you were buying expensive due to fundamental or technical analysis, or even because of greed, someone took it as an opportunity and sold to you at expensive price, and might be even interested in selling huge quantities at expensive price, which created more supply, and that is why the script started moving down. Similarly, you would have also experienced that as soon as you sell, the stock or script starts moving up, and again you get the feeling that someone is keeping an eye on your trades. The reason this is happening is because when you were selling cheap due to fundamental or technical analysis, or even because of fear, someone took it as an opportunity and bought from you at cheap price, and might be even interested in buying huge quantities, which created more demand and the script started moving up. This is why in performance optimization strategy, we do the logical correct action. We buy at cheap price and we always sell at expensive price. In performance optimization strategy, everything we will be doing will be logical. The logic will give you the rationale. The approach will be optimized. This will give you the information needed to enhance your trading, and the POS Plus live sessions will give you the opportunity to understand the logic and optimize with real examples. Let's look at different terminologies to understand demand and supply. Let's talk about different categories and how they are related to demand and supply. If we talk about trade action, at demand we will always buy, and at supply we will always sell. Trade type. Whenever we buy first, it is called as a long position, therefore at demand we always go long. Whenever we sell first, it is called as a short position, therefore at supply we always go short. Looking at it with business perspective, at cheap price we are always interested in buying, therefore we can call demand as wholesale prices. At expensive price we are always interested in selling, therefore we can call supply as retail prices. From demand we are expecting prices to move up, therefore bottoms can form at demand zones, and from supply prices can move down, therefore tops can form at supply zones. Because price can start moving up from demand, this can create an emotion of greed, and similarly prices can move down from supply, which can create an emotion of fear. Talking about the color of the candle, from demand prices can move up, therefore the color of the candle will be green, and from supply the prices can move down, therefore the color of the candle will be red. Why price moves? Price always moves because of the imbalance between demand and supply. Let's understand how this happens. The origin of motion or change in price is an equation where one of the two competing forces, either the buyer or the seller, becomes zero at a specific price. Let's assume that there are 4 buyers willing to buy ABC stock at 250 rupees, and each buyer is willing to buy 100 shares. Therefore, the total buy quantity at 250 rupees is 400 shares. A buyer can only buy if there are willing sellers available at the same price. Let's assume that 2 sellers step in and each of them are willing to sell 50 shares each at 250 rupees. Since we have 400 shares to be bought and 100 shares to be sold, one buyer will get his complete quantity. We will still be left with 300 shares to be bought at 250 rupees. Since there are no more sellers available at 250, the next seller will always be at an expensive price. Therefore, if the buyers have to buy, now they have no choice but to increase their buying price, which will result in prices moving up. Similarly, if we have 4 sellers, each of them willing to sell 100 shares each at 250 rupees, the total sell quantity at 250 rupees is 400 shares. A seller can only sell if there are willing buyers at the same price. Let's assume that two buyers step in and each of them willing to buy 50 shares each at 250 rupees. Since we have 400 shares to be sold and 100 shares to be bought, one seller will sell his complete quantity and we will still be left with 300 shares to be sold at 250 rupees. Since there are no more buyers left at 250, the next buyer will always be at a cheaper price. Therefore, if the sellers have to sell, now they have no choice but to decrease their selling price, which will result in prices moving down. Why price moves? Price moves higher at price level where willing demand exceeds willing supply, and price moves lower at price levels where willing supply exceeds willing demand. Let's try to understand how these levels of demand and supply will look like on the charts. Let's assume that on a price chart, prices were moving up and then started trading in a range, after which we had a strong drop. Why did the price decline? We just understood that the origin of any move in price is where supply and demand are out of balance. Would you call this imbalance as demand or supply? Since the prices move down, it has to be supply. We draw two horizontal lines engulfing the range from where price started moving down and call this as supply zone. After the move to the downside, let's assume that the price again started trading in a range and then all of a sudden started moving up. Why did the price rise? The origin of any move in price is where supply and demand are out of balance. What would you call this imbalance, demand or supply? Since the prices moved up, it has to be demand. We again draw two horizontal lines engulfing the range from where prices started moving up and call this as a demand zone. Who is on the other side? Who do you think is buying here? This is a person who is buying in an uptrend or buying because for him the company is fundamentally strong, which means that because of fundamental or technical analysis or because of greed, someone is now buying at an expensive price. Buying at expensive price is a novice action. Now if the price starts moving down, who is selling here? This is a person who is selling in a downtrend or selling because for him the company is fundamentally weak, which means that because of fundamental or technical analysis or because of fear, somebody is now selling at a cheap price. Selling at a cheap price is a novice action. Now that we understand the novice actions, let's understand the mistake which the novices make. Two key buying mistakes. Mistake number 1, buying after a rally in price, which means buying at an expensive price. And mistake number 2, buying at a level where chart has proven to us that in history, supply exceeded demand. Two key selling mistakes. Mistake number 1, selling after a drop in price, which means selling at a cheaper price. And mistake number 2, selling at a level where chart has proven to us that in history, demand exceeded supply. Our action should be to identify these novice traders and trade against them. At demand, we anticipate the price to rise. Therefore, if a novice seller is selling after a drop in price, which means at a cheaper price, we should be willing to buy from him at that cheap price because from demand, prices can move up. At supply, we anticipate the price to drop. Therefore, if a novice buyer is buying after a rally in price, which means at expensive price, we should sell to him at expensive price because from supply, prices can move down. Where are the market turning points? Price in any market turns at price levels where demand and supply are out of balance. Now you know how this picture looks like on a chart. As we move ahead with the lessons, we will be learning step-by-step process for identifying and drawing these demand and supply zones. This is Surjit Kakkar signing off. See you in the next lesson.